Now let's give the floor to our community bank discussant, Jordan Miller. And Jordan, the floor is yours.
Thank you very much. I don't have any slides to show, so you just see my information up there. I'm Jordan Miller. I'm former regional president in Central Ohio for Fifth Third Bank, and I'm currently starting a new bank called Adelphi Bank in Columbus, Ohio. That name, Adelphi, was chosen because back in the 1920s, there was a bank, an African-American bank in Columbus called Adelphi. It was Adelphi Building and Loan. Don't have a lot of information about it. We know it existed in the 1920s. When there was a new real estate project going up in Columbus, and they were tearing down the old building, they found underneath the building the remnants of Adelphi Bank. So it had been covered up with some type of siding. But I've been asked to provide commentary on the three research panelists that you've just seen. I won't reiterate a lot of their comments, but I want to give it to you from my lens as a banker that started his banking career in the early 80s and has retired, and one that's starting a new bank. So I saw a lot of consistencies across these research papers, and a lot of intermingling, I guess, of the data that they found. And I found overall that their work is very consistent with what I see through my lens as a banker and what I see, especially now that I'm taking on this role of starting a new bank. So I wish I could be there in person. This week, we're trying to close out our fundraising for a bank. We've kept the date open until September 30th. So we needed to raise about $20 million. We got about 22 committed, and now I got to collect that before Friday. So that's why I'm not there. Lots of meetings. I've not only asked a lot of questions as I looked through their research. I kind of did a lot of this research on my own with me and my partners when we were starting the bank. So, first thing we did, we hired a marketing firm to help us understand the Columbus area landscape and to see if it would benefit from a minority depository institution. We want to know if it was necessary. Our research wasn't necessarily about these issues, but we did find a lot of similarities to what we found in relationship to the research that you just saw. So the first thing was we looked at a competitive landscape. So this kind of goes to the competition slide in Central Ohio. And our questions were, do we need another bank? And would another bank make sense? Would our bank make a difference in the African-American community? As you know, many banks have doubled down their efforts on diversity, inclusion, and equity and inclusion. They've also been tackling issues around ESG. And, we're just wondering, hey, how would another bank make a difference, or would it change the landscape in our minority community? So we took that lens. Also, during the formation of the bank, our team had to believe that we could offer a different outcome for people of color than what they are receiving today. So we asked, would there be different outcomes for African Americans if they dealt with African American bankers? Basic questions were, will we be able to gain trust of individuals that don't trust their banks, or from those that have not had a good experience with their bank? Will we be able to make more mortgages to minority communities? Would our outcomes for mortgage and small business customers that are African American be different than the outcomes that they're receiving today? We've seen this from the research that they would, but at the time that we were kind of going through this, starting a couple of years ago, I didn't have the advantage of having this research. One other key question that we asked ourselves was about the difference we can make in building wealth for African Americans. After all, that's our primary mission, is to help the African American community build wealth through generation. But how would their outcomes be different? How do we help our customers manage their personal finances and their businesses through these difficult economic cycles that we've heard about? The great financial recession, the COVID-19 pandemic, And then currently, even in our inflation environment that we're in, as we know that all of these negative economic cycles or difficult economic cycles have adverse relationships, impacts on minority communities. So while everybody suffers, minority communities typically suffer a little bit more as they're typically at the bottom of the totem pole. So as a new bank, could we change any of these outcomes? So it's the lens that we were looking for. And what would we do differently than other institutions in our market? So we asked a lot of these questions about starting our bank, and now we're seeing if it lines up with the research. So I'll walk through some of the points that we're making. And I'll start with competition. So when I think about competition as a banker, you'd always think about what are the other banks doing? I mean, I ran Fifth Third Bank, and the idea of Fifth Third Bank was we operate like a community bank. I was responsible for Central Ohio. I had a pretty large region, had 93 branches, and I had a pretty big balance sheet. But I was competing against the hometown bank. So I'm in Columbus, Ohio, Cincinnati. The hometown banks that were here were the community banks and another large regional bank. And so our motto was, how do we compete against the hometown banks? So we structured ourselves just like a hometown bank. So I had responsibilities for mortgage, I had responsibilities for investments, I had responsibilities for commercial bank and wealth management, as well as small business lending. And I had a CFO, I had an HR director. And so I was our bank model looked just like an independent bank. We were very decentralized. We had commonalities across all of our regions, but the way we structured our bank was to compete directly with hometown banks and act almost like a community bank. And so almost every single deal I financed for borrower, I mean, I found, we were being in a very competitive market. We always look to the creative solutions that we could provide. So much that banks stretch so when there's competitions, banks stretch their credit boxes to change the structure of a deal. We want to find what fit for a customer. We found that it just changing a rate or pricing on a loan 15 basis points or so was not the way to win the deal. The deal, and especially in a competitive environment, you had to be competitive on your pricing, but you had to be really thoughtful about the customer. So the fact that we were competing in a region that's highly competitive, in order to win deals, you really got to look at a number of different deals. So if competition works to get better deals for most of our clients, the question became, does it improve the chances for minorities and different gender backgrounds and racial backgrounds? Does it lead to them getting a better deal? And does competition help minorities gain access to capital? I think, which is the research that we uncovered, and it shows that it does. When banks operate in non-competitive environments, I didn't have that opportunity at Fifth Third, but I think it does allow them to dismiss or reject proposals from almost any business that they deem is not a good candidate for their balance sheet. We know that most minority firms are less likely to gain access to bank financing when they have limited choices and there's no competition for their deal. They can easily be stuck to the side, and banks can disregard or dismiss minority-owned businesses. I saw that a lot when I was a bank examiner when I first started my career in banking back in the 80s with the OCC. As more banks adopt these DEI and ESG strategies, so it's only natural for most of our competitors to do the same. So I think that gap will close as a result of things that we've seen here recently with the pandemic, with what we've seen with George Floyd. I think we've got a more conscious bank environment. And I think that DEI strategies and ESG strategies will help close the gap. And I think especially in large minority communities, competition will help drive better outcomes for minorities. The other thing we looked at was the other study that we looked at was the impact on minority representation on mortgage lending. So the question for us was, does it matter? Does it, and then kind of why does it matter? This study kind of researched the impact of minority loan officers in financing mortgages for other minorities. It basically concludes that when minority loan officers are present, they approve more loans for minority customers than those loans, and those loans are of a higher quality based on default rates, which is what we heard from the research. To me, when I first read this, it sounded almost like an oxymoron conclusion. I totally would agree with the first part, that minorities would help other minorities because they have a simple understanding and of each other's needs. But I didn't think that it would result in lower default rates. So I did read studies. I wanted to understand that. And I think it's been proven, as was mentioned in other professions, like healthcare, that minorities typically receive better outcomes from their healthcare providers that when they look like them, because they understand their unique needs. There are certain factors as an African-American I don't have to explain to my African-American doctor. So when I turned 40, the research suggests that if you're Black and you're 40 and male, you need to get your PSA checked, for prostate cancer. That's the age that you start at. I had a physician that didn't understand that. So when I went in for my annual physical, I said, hey, I need to get my PSA checked. And he says, you don't need that until you start 50. And that's a typical answer in the majority community. Most majority males don't have to deal with the issues of prostate, and they don't start getting checked until they're 50. But the recommendation from a physician for an African-American is to start when you're 40 because they have higher incidence. That's just a small example. We also saw that example being consistent with HBCUs. I'm jealous of some of my HBCU graduates because I see the attention that they received. I mean, I went to Ohio State and University of Maryland, pretty large colleges, and I got a lot of good feedback. Scored well on a lot of things, but all of my friends and buddies that graduated from these HBCUs, it just seemed like their college experience was so better, and that their education experience was so better because they had people around. They were surrounded by people that believed in everything that they were doing, and so they understand their unique needs for education. And the challenge with all of these is the number of mortgage loan office professionals. So I think the research adequately pointed that out as well. So the number of mortgage loan professionals in comparison to the number of mortgage loan applicants is pretty small. Now, you would think that gap would be closed because, most mortgage loan officers, they work on commission, and, you'd think that they wouldn't really care. Hey, look, if it's an African-American or white person or another minority group, you would think that because they work on commission, that would just, why would you care? Well, I think some of the reason that they care is because it takes more time to work with a minority applicant that's typically that typically may not have the same FICO scores and the debt to income ratios and have the other things. So that soft information that was mentioned, that ability to get to know that other person and understand, so you can disregard some of the hard data once you know a person. So I don't think any of their conclusions are particularly surprising. I like that the study shows that a minority with a similar credit profile to a majority person would be rejected. So I just think of what is that gap and why is it like that? So again, when you take the time to understand and help a person in the pre-application stage, I think you're likely to get better outcomes from a borrower. So it makes sense to me that you get those outcomes when you know a person or when you have time to sit with them and you help them with that pre-application stuff. So I would speculate that there's a lot of unconscious bias in the mix that goes on here, and I think we all have it. We all have different impressions of people that we don't know and don't understand, and that's just a natural phenomenon. It's just a natural thing that people experience. So let me get on to the last research, which was minority-owned banks and the resilience to crisis. And they talked about Maggie Lena Walker, and they said she was right. Well, I think she was right. I think she was onto something. So this this research points out that makes minority communities recover from economically challenged business cycles faster than those communities that don't have minority banks. And the primary objective of most African-American-owned banks is to end the poverty cycle, promote generational wealth, and increase economic resilience. So we know that in difficult economic cycles, minority communities get hit harder. They're typically first fired because they were the last hired. They typically are underrepresented in the C-suite or in upper levels of management. Their businesses are often less capitalized, and so a downturn can have a big impact on them. They're going to get harder because they don't have the capital to withstand those losses. I think the study found that during the Great Recession, minority bank presence was a strong predictor of economic resilience. If there was a Black bank in that community, it reached a similar conclusion in COVID, but not as much. And I think the explanation there is that, COVID, we're operating like we're operating now. We're talking to people on Zoom. We don't see their body language. We don't really know if they're engaged. We don't really know if they're listening. I know we've all experienced the virtual meetings, and you can't tell people are paying attention or if they're listening. And so I think you lose a little bit connectivity with people during that period of time. But this study also talked about taste-based discrimination, and I hadn't heard it described that way. But much of it is a preference for a specific group over another. It also talks about the better outcomes for relationship-based lending, transactional versus transactional lending. And I think community banks do a really good job of that. They typically know their customers. Even at Fifth Third, when we were trying to simulate a community bank, it was a little different because we had silos between our retail bankers and our commercial bankers. There are a lot of silos between the mortgage guys and the commercial guys. There were some silos between the investment people and the commercial folks. So it wasn't like a community bank. I think everybody operates and works together easily. You eliminate those silos because you don't have all those big departments. So I think that that's a challenge. Relationship banking uncovers information about the borrower that leads to better outcomes. So all in all, I think all of these studies are very consistent. And what I like to do is a story. When I worked at Fifth Third Bank, I had an old president during my Cincinnati days that he actually had left Fifth Third to work for another bank, and later in his career is when I met him, and he became kind of a mentor to me. He was a white guy, but he had a big passion for lending to the Jewish community, and he did that at a time that not many banks were lending in the Jewish community, and it was just religion, discrimination, who knows all the factors, but everybody thought that he was Jewish because all the Jewish businesses came to him. He had the market share in that sector. And he told me a story about one of his Jewish clients that was having challenges with his business. And he came to him and he says, "Hey, I'm going to have a problem making my payments. My business is kind of going south. I'm going to figure it out, but I need some time." And he said, "Well, how much time do you need?" He says, I need about 30 to 90 days. So he said, "Okay, well, take 90 days and come back and see me." So a guy comes back. When he comes back, he's got 20 checks from all the Jewish community. So each of the Jewish businesses, many of the Jewish businesses that knew him and knew he was going through this challenge with his bank, they all wrote checks to him and he gave them to the bank. And that's how he paid off the loan. But that told me a lot about what minority banks can do and how they can change and how they can work together. And that to me was a great example of that. So, my conclusions are that all of these studies are consistent with my experiences from my early 80s in the banking until now. Starting this bank is reading some of the research has re-energized some of our efforts. I think it's, I don't think we can fix all of these issues around discrimination. We can't change our biases. We can't change how people see us, but we can make a big impact, and that's the goal of our bank is to change the outlook of minorities in our community by giving them access to credit. So I'll stop there, and I'll let the moderator come back up. Thank you.
Thanks, Jordan.